Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, February the 27th. I want to take just a brief minute to discuss what equities did last week as we saw the single worst day in the S&P 500 since December 18th of 2024, with the S&P down last Friday 1.7%, sending the sector down, or the index down, for the whole week 1.66%. So as you can see, all the losses for the week were on Friday. The mid cap index was hit much harder. It was down 3.02%, and the small caps as measured by the S&P 600 were down the most, down 3.6%. So the small and mids got really hit last week. And this really happened on Friday when we got the consumer confidence report and missed by about 10% on the downside to the worst levels we've seen since November of 2023. And that's important for a couple of reasons. We'll talk about that in just a second. And that sentiment set the markets tumbling down on Friday. And the reason it is because consumers and investors are fearing that growth is slowing, inflation remains elevated, and we are moving into a period of stagflation. We don't know yet the implications of the tariffs and the policies and the new administration's stance of deregulation, their growth prospects. Are there tax cuts? Are there not tax cuts? Is there going to be deregulation? If so, how much? So we're still so much uncertainty. And the last time the market had a 10% pullback was actually October of 2023. So we're about a year and a half out since our last 10% pullback. And remember that date I said that was so important was November of 2023. So the last time consumer sentiment was this bad was coming right off of a 10% pullback in 2023. So this is a leading indicator that many investors saw as time for opportunity to get out. But over the last 7 days, believe it or not, the average stock in the S&P is actually down 13%. The index itself is not near down that much, but the average stock within the index is down 13%, showing you the volatility that's going on. So what we may have just seen over the last week or 10 days is a little bit of a stealth correction in the market where you don't see it up top on the headline, but underneath the index itself, you're seeing a lot of this correction happening. And the reason why you may not have seen the index down so much is some of your large, big mega cap names, while they're down some, they are not down that 13%, and that is what's propelled the market higher. But one of the other things that we have seen is we've also seen the 10-year Treasury retreat from 4.6 to 4.3. While that's not necessarily a huge move, what that shows is that investors are worried about a slowdown of the U.S. economy, and that money is piling into the 10-year Treasury, which typically is an indicator that money is leaving the equity markets and moving into the bond market as its perceived safety. The other thing that you're seeing happen in equity markets is a rotation from high growth names into more value style names. And this process can be a little messy too, and why you've seen some of these significant pullbacks in some of these names, whether it be off earnings and guidance reports or just sentiment about the overall sector itself. You're seeing these second and tertiary names in the equity markets. Those are the ones that are down higher, and those are more the growthy names as well that you're seeing down more, that 13%. And the reason why investors are moving more to that value side, was we talked about last week, is they're not going to be as impacted by the macro events. They're more mature companies that have good, stable cash flows regardless. They're sectors that have been disliked by the market for the last 2 years as we've been on this growth tear. Think about sectors like consumer staples, healthcare. These are things that are going to be, slow down proof per se, or recessionary proof, or however you want to use the terminology there. But they're sectors that should outperform in a growth slowdown, because no matter what, you're still going to get your health care, you're still going to get your staples at home, you're still going to need that doctor's visit and things like that. So that's why you're seeing the transition there. And when you've had some of these names that are on sticks, you're going to see a big correction down as it's rotating away from those, as more and more people rotate out of those into what is perceived as more safe, secure investments. So if you have questions about how to navigate this volatility and this correction that we're seeing, feel free to call us. We'd love the opportunity to speak to you. You can reach us at 904-346-3460. Or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.